Welcome to Beanstalk, M&J's podcast where we are sharing and showcasing our areas of expertise through conversations with practice leaders on their knowledge and experience.
Well, welcome to today's episode of Beanstalk. We are going to dive into a favorite topic of mine, international tax. And to do that, we are welcoming the leader of our international tax practice, William Roberts. Well, thanks for being here.
Thank you, Brent. Thanks for having me.
Yeah,
Glad to be here.
You know, obviously, international tax. We can talk for days about the issues that surround it, right? So, but the goal I think today is just, hey, what are the high level things we need to be thinking about?
Right.
And later on, I think we'll dive into specific issues here or there. But I mean, really from the outset, it's hey, I know I want to expand abroad.
Right.
What are the first questions as a business I need to be asking?
Okay.
Once I've made that leap in my head.
Right. And that's the thing too. The first thing you really need to be asking yourself is not a tax related question. It's really why do I want to go overseas? Am I starting to sell more products overseas? Do I have more clients overseas? Do I have people requesting my services from overseas countries? And so you have to ask yourself, okay, why do I want to go overseas? And a lot of those questions are very legitimate because you don't just want to go over there because you want to say, oh, I want to set up operations in France. You have to have clients, customers, all that going over there. So that's really one of the first things you have to ask yourself. Why do I want to go over there? And there's different things you need to consider over there. What are my choices of entity? What sort of political risk do I have to think about? What are the legal requirements? Who do I staff it? Who do I staff it with? It's one thing to say, I need to set up an organization in some third world country that's always, under civil war. That's great and all, but if you need somebody from the U.S. that's going to go and supervise that, it might be difficult to try to do that. So the first questions you really kind of have to ask yourself is, why do I want to go overseas and how am I going to do this? Has nothing to do with tax.
Yeah, right. And I mean, suffice it to say, the considerations for opening up shop in the U.S. and abroad are very different, right? So what are good examples of the differences, right? I mean, employee related, whatever.
Right. Well, again, it's like, if you think about your employees here, they have certain requirements, they have certain legal aspects, certain legal laws apply to them in the sense that, maternity type leaves, well, I guess it's birth related type leaves, in different sorts of vacation periods and stuff like that, and different kind of incentives to bring, people onto your, into your job. Overseas, they have different regulatory requirements. They have, some places it's hard to fire folks. In some countries, your manufacturing employees have to be on part of your board or have to be, having, conversations and making, helping decision making, the kind of stuff, and they don't have at-will, termination. So a lot of those type of issues come into play. The length of PTO sometimes can be, here in the U.S., 4 weeks is kind of standard over a year, but it could be 7 or 8. So a lot of the types of, just employee, issues you have to think about. Social Security taxes. You have to pay different, Social Security regimes, whether they're foreign persons or not. U.S. people that go overseas, if they're there long enough, you'll actually have to pay U.S. Social Security and foreign Social Security. So you have to think about, okay, how long is this person going to be there? So trying to determine, are you going to hire locals, employees? Are you going to hire local contractors? So you don't really have employees. You could hire, instead of hiring employees, you could use an employee of record, which basically says somebody else hires them for you and you lease them. So you don't have all these employment issues to worry about. Mm-hmm. Or if you send people overseas, they're going to want an expatriate package. It's not going to be the situation where I can charge, I can pay them $100,000 here. Overseas, you may have to pay them $200,000, for company housing, benefits, travel expenses, because they're going to be away from the house and away from home and loved ones. So, and plus, the idea of going overseas and being away from the U.S., it's a tough pill to swallow for some folks. So you have to compensate them for that.
Right.
So there's all those issues. Yeah.
And then, I mean, in your experience, does your U.S. advisor help out with that, or is that something you need boots on the ground for? Right. I mean, from an advisory perspective.
Yeah. Well, I think the most important thing you can take away from our conversation about any of this, no matter what we talk about from here on out, is hire local country advisors. Mm-hmm. Hire an attorney. that can help you through all the legal issues for employment, regulatory, because when you go overseas, you're subject to different sort of like OSHA type requirements. You're subject to different environmental protection type requirements. So all the legal issues that you could be facing, you need an attorney. And then also you'll need an accountant that's knowledgeable and, that's really knowledgeable in the local country tax laws and the accounting aspects, because we have U.S. GAAP, which is a certain way we prepare our books, and most people who know that are part of the business world know about U.S. GAAP, but there's something called IFRS overseas, and that's a different international financial reporting standard that you have to convert books back and forth to. So if when you're preparing like a 10K or a 10Q or something like that, you have to convert those financial statements into US GAAP. And there's all those kind of different ways you can record things overseas as opposed to how you treat them for US purposes.
Right. So, really, not just obviously the costs of going abroad, but there are administrative costs that come with just, hey, translating financials, like hidden costs in there that you just don't consider, right?
Right.
What other considerations like in that realm do you?
Well, okay, you talk about financial, a lot of, when you go overseas, you have to conduct your business environment in their local currency. Now, luckily in the European bloc, there's the euro, but then Sweden has its own, Denmark has its own currency, Iceland, I can't remember if Iceland has its own, but different countries have different currencies that you have to think about, and the volatility in those exchange rates, can really affect the bottom line of your business. To give you an example, when I first started doing international tax, the pound to dollar rate was basically 1 pound equals $2. Now it went down at one point as low as 1 to 1. I think I felt like a half off sale when I went to the UK. Now it's kind of middling and creeping back up, and who knows where it's going to be in the future. But that could affect your bottom line in the sense that, okay, I've got a contract for 100 million pounds. Well, let's bring it down. 1 million pounds. That's back in the day, that would have been $2 million.
Right.
And you would have said, well, that's a great windfall. That same contract 5 years later could have been only worth $1.5 million. And so, that affects, and that's, if you have a long-term engagement or a long-term construction project, let's say, what you think you're getting paid for, or even if you get paid in US dollars, the exchange rate when you receive those payments will affect a gain or a loss that you have to recognize not only in your financials, but there are tax aspects that, where you tax if you have an obligation, like a loan that's denominated in a certain currency, and the US dollar of that is, let's say, $100. And when you go to pay it off, you only had to pay off 90. Well, that's a taxable gain to you under the US tax laws. Or if it's now you have to pay 110, that's a $10 loss to you. So looking at financial exchange gains and losses and mitigating that risk, very critical. And if they're big enough, or if you have enough volume, you should really start, getting a financial advisor on board to help you do financial hedging.
Right.
Try to hedge those transactions and hedge the volatility. So,
and that, and just going back to your political risk thing, right? You want a exchange rate that is going to be at least fairly consistent, and if it's not, then
that's right.
Yeah, you want to hedge your bets.
That's right. They're hyperinflationary currencies like Venezuela. At one point, if you'd have had an investment in Venezuela, 20 years ago, it would have been worth whatever it's worth. But now it's basically worthless because the exchange rate has gone up. Yeah. So that's and there are definitely countries with currencies like that. Now we have different accounting tactics and tax tactics to kind of mitigate that and smooth it out. But for the most part, that's a huge risk.
Yeah.
Yeah.
Well, going into kind of the tax aspects, right? That we have obviously our U.S. tax, the way we're going to tax these entities abroad. Can you speak a little bit about how do I set up an entity abroad? Is it going to be subject to, tax abroad? Will it be subject to tax here? What are the considerations that go into just setting up shop?
Right. And that's I think to me the second question you have to ask yourself after why do I want to go overseas? What's the reasoning? Not just willy nilly. Hey, I think it'd be great to have a place in France. It's what type of entity you want to use, right? And you have your typical the local country versions of corporation, local country version of a partnership, a branch, an LLC, and just like in the U.S., different types of entities will incur different types of taxations. For example, so and I think a lot of the times it's kind of small differences. But if you're setting up shop over in Europe, just like you would here, you're subject to corporate taxes. State and local taxes generally isn't too prevalent in a lot of places, but if you go to Switzerland, for example, they have they have cantonal tax. So they basically, there are different states in Switzerland apply in addition to their local tax, in addition to their federal tax. You can have municipality taxes. So let's say in the big city of London or France, they may have their own their own taxes. Singapore, there are different taxes that are at the municipal level.
I feel like there are a lot of value-added taxes outside of the U.S. too, right? I mean,
that's right.
And it's taxed on. I mean, is it taxed on services? Is it taxed on goods? Is it everything? Or?
Yeah, VAT is basically a glorified sales tax, right? Yeah. And it applies at various rates. They're generally double what our U.S. sales tax rates are, but they apply to different goods and services, and they have different rates. Just like us, they do tax advantage VAT rates. But VAT is definitely something that you have to, if you're going overseas and you're selling products. You will have to register for VAT. You will have to collect VAT and remit it to the local, the VAT authorities. So income taxes, VAT taxes, then there's special taxes you got to think about too, right? There's at one point there was a Germany reunification tax that helped rebuild Eastern Germany. It's kind of been scaled back and highly selective for like corporations, but yeah, you had to pay that tax. And so there are other taxes that you have to think about besides just those income taxes and VAT taxes. And then there's Social Security taxes that you have to withhold on your foreign workers. So just like in the U.S., you have all these foreign taxes you get to think about.
Yeah, you're really making me want to set up shop abroad. I feel like the tax is going to be all of it.
Yeah, I mean, just think about it. It's just like going to another state, except for they don't speak English. Well, actually, most foreigners, most foreign business folks do speak English a lot better than we speak English. So that's always a good thing. Yeah, and I think a lot of the foreign companies, that is one of their hiring requirements. I will say that they have to be fluent in English in addition to their local country language, and then maybe one other one. Maybe like if French and German, Italian, that kind of thing. So,
but generally, you're going to find a comparable tax system where you are, similar to the U.S., not exactly the same,
right?
But, that's local tax, right? So how does that impact my domestic tax, right? I mean, I own this, I own a business that's in the Eurozone somewhere,
right?
It's making money, it's taxed there,
right? How's
that taxed here? Or I mean, and what are the considerations that we need to have when we're setting it up?
Right, and that's the lovely thing about U.S. taxes is the U.S. taxes you on your worldwide income. So what that means is no matter where you earn it, and this applies to individuals, corporations, partnerships, worldwide income is a U.S. taxable concept that wherever you earn it, however you earn it, whatever source it comes from, you are taxed on that. So let's say you earn $1 million in France, and France taxes you on that income. Well, the U.S. also says, hey, we're going to tax you on that as well. So let's say, I don't know the French tax rate is off the top of my head, but let's just say it's higher than ours, right? It's 25%. So if you earn $1 million, France taxes you at $250,000, and then the U.S. will tax you at, let's say, top rate of 21%. So you're looking at 25, 46 percent tax rate on your worldwide tax rate. So
probably not the best.
Yeah, probably not
return on investment.
Right. Then you ask yourself, well, why the heck am I even going overseas? Well, luckily, this is why you hire your local advisor overseas, is they can help you take advantage of any local country laws that can help mitigate that tax or lower the tax rate or exempt it, whatever. And then there are income tax treaties between two countries that will help alleviate double taxation. And then if that doesn't work, we have the U.S. offers you a foreign tax credit that you can take for foreign taxes paid on the income earned in France. So there's different ways of doing that to lower your tax rate. And really, going back to the entity choice in the local country, that will really affect how you're taxed in the U.S.
So can I choose how I'm taxed in the U.S. based on how I'm set up in the other country? Right. Well, I mean, obviously, it will impact how I'm taxed in the U.S. But I mean, what options are available? Right. So, like, how can I, in a given situation where I'm going over there, I probably know I'm going to invest in that entity. I'm going to lose some money. Right. Or tax. I won't have taxable income. I have losses. I mean, is there a strategy there to where I can use those losses in the U.S. or walk me through that? Yeah,
now you can. I mean, if you're going to have losses, generally the idea of if you have an entity making losses, you want them to flow directly through to you, right? And so you can do a couple things. One, you can set up a branch which is basically you have a sales office or an unincorporated entity, and losses will flow directly through to your U.S. return. You can set up a partnership where and just like a U.S. partnership, the losses come straight to you. Or let's say you don't want to do that because under certain regulatory laws, they say if you're going to build this product, let's say if you're going to build this ultra chemical that could be dangerous, they want you to have it in a corporation,
sure.
right? Yeah. So you think, well, I'm stuck with this corporation. Well, that may be true for foreign country purposes, but we have something called check the box in the U.S. tax regime, which basically means as long as your entity is not what we consider a per se corporation, like a public company or corporate, like a U.S. Inc., you can make a check.
It has to be taxed like
that. It has to be taxed as a corporation. Then you can make a check the box election. And what I mean by check the box is there's literally a form that says, how do you want this entity to be taxed? And you check the box and you say, I want this corporation to be taxed as a disregarded entity. Mm-hmm. Or if I have one owner, if I have two owners of this corporation, I can check it as a partnership. But the point is you can take this entity for local purposes. It's still a corporation, still legal liability protection, all that good stuff. But for a U.S. tax perspective, all those losses come back. Yeah. And there are different things you have to think about. Well, once it turns profitable, then you have to worry about, okay, well, all right, now if I want to defer income, then, then I had to think about that. But that kind of leads me, that's a perfect segue, though, into U.S. taxation of these entities, right? Because, again, not only do you have to worry about but think about the flow through. If you do have a corporation and you don't make the check the box election on it to be a flow through, you used to be able to defer income that was generated by that foreign corporation.
Yeah, that was my next question. Well, we've got losses.
Right.
Right. Maybe we can take advantage of it. Maybe we can't. Depends on our situation. But now we got income. Right. And we want it back home to either invest here or anywhere else, right? How do we get it back? What's okay, and how? Yeah, what are tax efficient strategies or just kind of things to think about,
right?
As we're doing this,
right? Back in the old days, you would say, well, let's keep the branch. It's a branch while it's generating losses, but now that it's generating income, we want to defer that. We don't want back on our return, so we would uncheck the box and make it a corporation again.
I feel like that's kind of changed.
That's kind of changed too. And here's the thing. Nowadays, before, like I said, general partnerships branches flow through. Corporations used to be, money kept there, it stays there. Now, with these what we call anti-deferment regimes, which is Subpart F, we can talk about in here in a second, and GILTI, pretty much all the income that if it's a controlled foreign corporation, all the income that controlled foreign corporation earns is coming back to the U.S., whether you like it or not.
So the cash is sitting abroad.
That's right.
But the IRS is saying, no, that's your cash already. We're going to tax it.
That's right. If you have a CFC, you're subject to these two regimes, and let's say you earn $100 million, all that money is coming back to you in your gross income on your tax return, whether or not cash comes back to you. Yeah. Now, luckily, that's in year one. Let's say in year two, you want the cash back or you need the cash back. They won't tax you again twice on that.
Right.
So that's good. So automatic inclusion, and so the parameters of this are what's a controlled foreign corporation, right? A controlled foreign corporation is basically a foreign corporation that's owned greater than 50% of vote or value by U.S. shareholders. So it could be like 50.00001% owned by U.S. shareholders, and U.S. shareholders are shareholders, U.S. persons, obviously, that own 10% or more of stock of that corporation. So, for example, you own 50% of the foreign corporation. I own 50% of the corporation. You and I are both U.S. shareholders, and this foreign corporation is now CFC.
Sure.
Yeah. So now
we're subject to all these rules.
Yeah. So now when CFC, now anything it earns, it's going to come back to our returns. You get out of that $100 million, you get $50 million. I get $50 million. I feel like it's an Oprah moment, right?
Yeah.
You get $50 million. You get $50 million. And whether or not we actually get cash, we have to report that on our income. Yeah. So it kind of seems unfair. But what was happening is Subpart F was people were playing shenanigans with their tax entities, right? They would say to myself, okay, if I sell this widget overseas, I'm going to get taxed at, let's say back in the old days, tax rate at 30-something% tax rate, 35%. But if I send it through a Bermuda company or a low tax company and they on-sell it to my customers in France, well, guess what? All the trapped income, all the real trapped income is now in that low tax jurisdiction country. And
as long as I don't send the cash back, I can just
right. And so then the tax rate on that was so much lower. And then when you bring the cash back, there are different different ways to repatriate it, but you basically were reducing the amount of income, the tax that would be payable in the U.S. And so that's when they said, okay, all these shenanigans, they call it Subpart F now, and that brings it all back.
So walk me at a high level through the new regime, right? I mean, it's fitty, it's guilty.
Right.
You know, we won't get into beat, but kind of what do those mean for us as domestic taxpayers?
Right. So back for CFCs, Subpart F is calculated at the CFC level, right? So whatever it earns, it can get Subpart F income, and it comes back to you automatically. Guilty, again, anything that's not Subpart F income.
Guilty, which stands for?
Yeah. Guilty means global intangible low tax income, which basically means nothing.
Pass the test.
Yeah, it basically means nothing. And now, they also have renamed it, and I won't go into all the details, but they've made some changes to it under the OBBA, or OB3 is what being referred to now.
Yeah.
But OB3 basically has kind of taken away some things, and now they call it basically they call it necktie, which is basically, we're not going to get into that, but let's just call it guilty for our purposes, because a lot of people are still going to have a lot of time trying to figure out, to use the new vernacular. But anyway, so basically, if you have income that's not Subpart F, pretty much everything is coming back to you. So for especially in 2025 or 2026, everything you earn overseas is coming back to you with no sort of delay in that. And what that means is, so you get the money back, but you get a deduction for that on that income. And after you do all the calculations and deduction, basically you are now getting taxed at a rate of 14%. As opposed to 21%. So there is value in that sense. And what that's trying to do is the Trump administration is trying to bring your IP back to the U.S.
Sure.
Even though guilty and it has intangible tax in there, but for the most part, it didn't. It was really everything, for lack of trying to get into terms of art and all this kind of stuff. Everything that's in there is coming back. And again, that was by design because the Trump administration wanted to bring IP back to the U.S.
So did the new act, did it impact? I mean, I read a little bit about it. Did it impact this significantly at all?
Yes, it did. It did because, again, back in the day before guilty came into play, you tried to work your way in. You tried to avoid Subpart F unless you wanted to have Subpart F, because there's not, tax is neither good nor bad. It's dependent on what sort of tax attributes.
How long can you avoid it?
Yeah. Well, and here's the thing too. It used to be back in deferment. It was going to come back at some point and be taxed in U.S. return. It's just used to have the option of deferring when that event would happen.
Right.
But don't worry, everything is taxed in the U.S. at some point. Now it's just everything all at once. But back in the day, you would say, well, I try to avoid Subpart F income so that all my income stays there. Or if I have some expiring foreign tax credits that I could benefit from Subpart F foreign source income, then I would say, okay, well, let's let the Subpart F income come on through so we can take advantage of our favorable tax attributes. And so planning, I used to get offended by having Subpart F generated for a taxpayer, but then I got thinking, wait a minute, we've got expiring foreign tax credits. Let's bring some foreign source income back in. So, why don't we find ways?
So that's where the conversation has shifted is
Right.
What sort of character are we looking at
versus
timing? Because the timing seems like it's taking care of itself, right?
Right. And it all comes in. And so, again, there's no deferment. But now, I will say the only time you can really kind of avoid deferment now is if you are in a jurisdiction that is what we call high tax jurisdiction. And what that means is the effective tax rate on that income is greater than 90% of the U.S. tax rate. So if you have foreign income that's subject to a rate greater than 18.9%, for example, let's say it's 25%, then that's not guilty income. It is guilty income, but you don't have to bring it back because it's high taxed.
Yeah.
That is the only time you can really say, okay, well, I'm going to wait till I bring that money back.
Okay.
And then there are ways to bring that back tax-free as well. So
I don't want to get into too much of the details.
Right.
Every now and then when we start talking international tax, not you and me, but just when I start reading about it, my eyes gloss over a little bit. Right. So, but we hit on a few things, tax treaties, foreign tax credits. How does that interplay with, these deductions? I mean, are there ways to take advantage of the treaties, to take advantage of foreign tax credits? I mean, it sounds like there's still a lot of planning to do, right? I mean,
right. It's planning. Planning is more limited than it used to be, but it's still out there.
Yeah.
And as far as taxes, being subject to taxes in your foreign operations, the first step you need to think about is there anything my local tax advisor can do to lessen my foreign tax impact? Mm-hmm. And the next step, if that can't happen, then is to look at a treaty. A treaty will help you reduce your tax your double taxation on there. But the point is you can't be subject to taxation in the foreign country. So in other words, if you have what they call a permanent establishment, which is a bricks and mortar operation, meaning like you have a sales office or you have a manufacturing facility, then you're automatically subject to taxation in that foreign country. And it's not always just bricks and mortar like Canada has. The U.S. Canada income tax has a situation where if you're in each other's countries for greater than 183 days and you get 50% of your gross income comes from that other, comes from Canada, then you're subject to having what's known as a services PE. So you don't even have to have a bricks and mortar operation, you have a services PE. And why that's important to having a permanent establishment or PE is that you are now taxed on all the income attributable to that PE. So you're paying local country tax, federal, local, state, VAT, all that kind of good. Well, you can be subject to VAT irrespective. But my point is the whole trick about planning is try to avoid having a PE.
Yeah.
If you're going to set a manufacturing facility over there or a CFC, you're probably there.
You're probably there.
You're there. But let's say you're a U.S. company and for some reason you don't want to go to France. You don't feel like dealing with France or the UK or Japan or wherever you want to go overseas. And you say, well, I just want to sell product in there. And so therefore, if you don't have a permanent establishment, and there's no other attributional permanent establishment clause, then you can sell goods and products in there, goods and services in there, and not be subject to that foreign country's local tax jurisdiction. Now that is something you need to carefully plan into because there's a lot of time requirements. If you start, basically it's kind of like a state and local concepts. The more and more touch points you have with a foreign country, the more and more likely it is.
Yeah, it's akin to like a Nexus issue.
It's permanent establishment and Nexus are very similar concepts. It's just foreign versus state. So now if you have a PE or you don't have a PE, let's say you have a PE or you have a foreign operation, or let's say you just want the treaty to apply to you. You just want treaty protection from something. And the reason I said it is because also, even if you do or don't have a PE, and you have dividends, interest, rents, and royalties that are not related to that PE, the foreign country will withhold taxes on that, just like we will withhold taxes on payments going overseas, so that we can ensure that you're not escaping.
We're getting our share.
Yeah, everybody's getting their share of foreign taxes. Well, the treaties will then mitigate that by lowering or effectively reducing the withholding rates, just like they would income tax rates.
And there are countries that have obviously more beneficial treaties than others, right? So, I mean, it is a consideration of, well, how can we transact between here and Germany is probably different than here in Italy, just based on, our relationship with that country. That's
right. We have about 66 treaties in effect right now. So not every country out there in the world has a treaty with the U.S. And in particular, if you're going into Central America or South America, we don't have very many treaties with them. Yeah. Russia, that's no longer there. Although we do have treaties with some of the Kazakhstans and all the other parts of the USSR, former USSR. So you got to look at when you're going overseas, you have to ask yourself, okay, I really think this would be great to go in this country, but this country over here has a treaty and it's just right next to the border, so I could,
it's like I can avoid a lot of uncertainties.
That's right. If I set up shop here in this country that has a treaty, I can set up and just go into here that doesn't have a treaty, then that's more beneficial. Now, so that brings up another set of issues. Treaty protection isn't automatic, right? You can't just say, oh, the treaty applies to me, don't withhold or lower my tax rate. First, there's like 4 different things you need to consider. One, are you a resident? Okay. Do you not have a PE or do you have a PE? And then, if we're talking about dividend withholding tax rates, do you meet the special qualification for that 0% withholding rate as opposed to 30 or the 10% as opposed to 25? And then the last thing, we were just talking about the 2 different countries, but the last thing though is there's something called a limitation on benefits treaty article. And what that means is you're trying not to play games with the treaties. You're not trying to do shenanigans. So in other words, you're not trying to set up, you're in this country that doesn't have a foreign tax treaty, but you don't want to get taxed on the U.S. whatever. And so you set up a company in this country just right across the border that has a treaty. Yeah. And, when it basically has nothing in it, right? Sure. And all it does is receiving payments at a 0% withholding rate, and then you're shipping it back to you. If you have to look through that. And if the foreign country, the 2 countries realize, hey, look, the beneficial owner of this payment is not one of us country people, but it's a third party.
There are probably legitimate ways to set that up, right? But it's got to have some sort of economic substance.
Yeah, it's got to have, and that's kind of a concept that's been kind of outdated, but now it's coming back more and more in international tax. But that could be a subject of another podcast. But so there's all this treaty. The treaty is not automatic. The key thing to take away from a treaty, it's not automatic. You have to qualify for it, and then there's not every country has a treaty. Yeah. So after that, I know we're kind of getting, but after that, if you don't get the foreign tax treaty working for you, and the local country laws aren't working for you, your advisor's doing a great job, but he's just not being able to get you there, then we have the U.S. foreign tax credit. And what that means is, like we said earlier, the U.S. taxes you on your worldwide income, and so you could potentially pay that $46,000, then $100,000 you earn in France. Well, luckily the U.S. offers you a foreign tax credit. You don't have to take it. You can still deduct foreign taxes, but if you elect to take the foreign tax credit, you basically you can credit your foreign taxes against your U.S. source income.
Yeah. Needless to say, lots of issues, lots of opportunities, lots of options, right? I mean, the landscape is, hey, you need a local advisor. Right. You need a U.S. advisor that knows what they're doing. That can interpret the treaties, can interpret the nature of your foreign earned income. Right. I mean, are there any other U.S. considerations, reporting requirements? I mean, anything like that that we also need to consider?
Yeah, I mean, there's definitely with all the operations, there's always a form, right? No matter what you do, there's a related form that goes with it. If you have the CFC, like we said, you have to file a form. And when I first started those forms, it was called a Form 5471. Not to get too detailed, but that form was like maybe 10 pages long when I first started. Yeah. Now, a fully completed one can be 50 to 60 pages long, without real statements attached to it.
And if they don't file them, pretty big penalties.
Yes, $10,000 here or there.
Yeah. Per page sometimes, right? I mean, per form.
Yeah, per form,
per sub form.
Right, and give an example of what some of these penalties can be. There's something called an FBAR, and what that means is if you have if you have a foreign bank account over $10,000, you have to file these FBAR returns or these FBAR information over reports that says, okay, I own these foreign accounts overseas. A lot of times you legitimately have to have, like I said when we were talking about earlier, you legitimately have to have a foreign bank account so that you can conduct operations in your local country. But let's just say you're a mom and pop logging company in Washington, and you're earning millions of dollars, and you're like, I'm going to put this in a Swiss bank account and avoid U.S. taxation on it, or avoid, well, and this is kind of a real world example, in the sense that this mom and pop logging operation, had this couple $1 million stashed away in a Swiss bank account. IRS got wind of the fact that they weren't filing these FBAR returns, and they were penalized, millions of dollars in tax penalties and interest.
Sure.
And jail time can also come with these things. So, you look at the operations, and you need to make sure that whatever you do, just think to yourself, there's a form here somewhere I'm missing.
Yeah.
Even if you give over $100,000 to a foreign corporation, that's reportable as well.
Over disclosure is not going to hurt you.
Yeah, over disclosure is not going to hurt you. I mean, yes, right.
Yeah.
So, and then then with the foreign tax credit, you have to file a form there too, and we kind of briefly touched on that, but that foreign tax credit's a great tool to help mitigate your taxes, and it's not automatic. You can't just say, I'm going to take a foreign tax credit on that, and then you're done. You literally have to go through. It's very calculated. It's a very mechanical and very complex calculation. Simple in one sense. For overall, it's basically, the maximum tax credit you can pretty much take is your U.S. income tax on your foreign source income.
Yeah.
So, an example, let's say you have a subsidiary that let's say you set up a U.S. company that earns $100,000 in France. Again, I love France.
I love France.
I love France.
It's okay.
It could be Japan, take your pick, Colombia, wherever, right? So you earn $100,000 with them. That's the only income that's earned. Well, the tax rate on that $100,000 is 21%. And let's just go with a full rate, and your U.S. tax burden is 21%. Well, if that foreign country also taxes you at 25%, you pay, additional 25%, additional $250,000. Well, your tax rate tax rate could be 46%, but luckily the foreign tax credit will tell you that, okay, look, my U.S. tax liability is $21,000. That's my maximum foreign tax credit. If I pay more or less, if I pay less, then I pay the U.S. Treasury the difference. If I pay more, then I don't pay the U.S. Treasury anything, and I can take these foreign tax credits and I can carry them back or carry them forward.
Yeah.
So there is planning with that too. A lot of times you have expiring tax credits, and so you need to think about generating foreign source income. Again, I think that'd be a really good podcast topic. Something with talking about the GILTI and the FDII and how that interacts with the foreign tax credit.
Hey, you've done my job for me. I was going to ask you where we should go next, for the next podcast. So we'll keep that in mind.
Right.
But yeah, no, I think this is a good overview, right? I think it's, hey, we've got a lot to consider abroad.
That's right.
We've got a lot to consider structurally from a tax perspective. We've got obviously domestic considerations. And so, your biggest piece of advice earlier on was like, hey, get a foreign advisor, right?
Right.
I mean, is there the last parting piece of advice that you can, impart to the listeners, right? I mean, what is the overarching, other than get an advisor, is there something else that you want to kind of get out?
Yeah, I mean, again, think about your reasons for going overseas and know that, and in all honesty, I really think the business aspects are what you need to really focus on, and let your advisors minimize their taxes.
Yeah.
But there's so many other aspects to going overseas than just taxes, and they're all, regulatory, people, site selection, all the kind of stuff you generally do in the U.S., but they're overseas, and that's where you need to focus a lot of your time in, but also work hand in hand with your advisors.
Yeah.
So
you need a team.
that's right. You need a team. You can't just, So I think to me, that's probably the biggest takeaway. Is
Go get a team.
Go get a team. Right. That's right. That's right.
All right. Well, hey, I think that was great. So thank you for joining us today. Like you said, we'll be back for more in-depth things.
That's right.
But yeah, we're happy here to have William and his team dealing with our international issues. Thank you for coming.
Well, thanks for having me.
And thank you for listening. We hope you enjoyed this episode. Please do reach out to Mauldin Jenkins and William's team for any international issues and obviously any other business issues that we might be able to help with. Thank you.